Joining me now is a Schwab Network contributor, Sam Vadas, to help set up the action today. All right, Sam, we've got this parade of earnings this week, a parade of results in the banking sector, especially yesterday. We had JPM, we had Citigroup, we had Wells Fargo. Today, we're hearing from more giants in this space, Bank of America, which gives us more insight to the consumer side. They say the consumer is resilient, but they miss on revenue. And then we've got Morgan Stanley and Goldman Sachs to get into as well. Let's start out with Bank of America. Take me through some of your takeaways.
Yeah, so we've seen a mixed picture from the Bank of America this morning. So as you mentioned, it was a beat on the bottom line and a miss on the top. And so we did actually see the net interest income coming in above expectations there as well. Wealth management seemed to miss a bit as far as the estimates are concerned. Equities were also higher. So as I said, a very split picture for the Bank of America. As you mentioned, the banks that we heard from yesterday do suggest that they're not too concerned about the consumer. Certainly resilience, things do seem to be holding up as far as, the fact that the consumer is still going out and spending, obviously, as far as some of the credit is concerned. So things still seem to be chugging along. But then, as you mentioned, we heard from some of the giants as well. So the Morgan Stanleys and Goldman Sachs, which looked fairly impressive as far as the numbers are concerned. Let's just run through, obviously, we got from them.
We'll get into those in just a minute because I just want to dig a little deeper into Bank of America. I mean, I think, the point that Moynihan is making, Brian Moynihan, the CEO, about the consumer stands out to me, saying that the consumer remains resilient, healthy spending, asset quality. But net interest income, although it rose, it did miss expectations. So I think that's something worth noting there. And as it's a key metric that investors are following. Not being dinged in the pre-market in terms of the reaction here. So I think we'll wait until the earnings call to see what they say further about that metric. What I also noticed, though, investment banking fees slid there. I mean, obviously, that's not necessarily the bread and butter for Bank of America compared to, say, some of the more traditional IB institutions that we know, like a Goldman, like a Morgan Stanley.
Absolutely. But, I mean, as you pointed out, consumer banking certainly holding up. I mean, the banks don't seem to be worried about the health of the consumer at this stage. As you say, the devil's going to be in the detail as to what they obviously say about things as far as the outlook is concerned, what the C-suite is thinking about right now, particularly because, you had the likes of JP Morgan yesterday. Obviously, Jamie Dimon has warned, while things look pretty healthy over there, about the potential risk of tariffs down the pike. And obviously, he has warned about stagflation in the past on a number of occasions. So, obviously, you and I were just listening to Gary Cohn as well. And, he was talking
former
about
GS guy.
Exactly. And he was talking about the fact that, while it might not be showing up just yet, although we did see a little bit of that sort of pass through in the CPI print yesterday, that consumers will pay. Because, while you might be able to swallow it for now as far as your supply chain is concerned and absorb some of that and pick up the tab, that inevitably the consumer will pay. So maybe it was just a bit too early to tell as far as, sort of the consumer banking side of the equation for now with regards to
or also the consumer just maybe holding up because the job market is holding up. But let's get into these results from Goldman. They did beat expectations on both the top and bottom line. Take me through some of your takeaways here.
Yeah, revenue was a clean beat. 14.58 billion versus 13.5 billion. Then obviously we've seen a lot of the trading activity holding up quite well. You look at where we are now as far as these record highs in the capital markets versus Liberation Day. So no doubt that has helped as far as the tailwind is concerned. When you look at some of that trading activity, equities, it was a beat there, 4.3 billion on estimates of 3.72. So things do seem to be holding up quite well. It was a sort of similar story as to what we got yesterday as far as the investment banking doing well on the deal making over at JP Morgan as well. Certainly as far as the broader themes that we're looking at when you look at the equity markets, M&A activity picking up as well as the IPO recovery as well. So that seems to be helping things chug along as far as Goldman is concerned. Quite some impressive numbers.
As we know, volatility often just bodes well for the banks, even though it was difficult for investors the previous quarter and bumpy for investors. either side of the equation, whether stocks are going up or down, heightened volatility is actually helpful to the bank. So trading revenue up 22% on a year-over-year basis for Goldman. So that stands out to me. And then equities trading, a big part of that, up 36% year-over-year. So, you know, although deal making was a little bit slower at the beginning of the quarter, we know deal making is obviously picking up. We talked a lot about that. Yeah. But, you know, seeing that increase in trading, that helps balance that out. And then, you know, it kind of lines up with what we saw from JP Morgan Chase and their increase in trading activity as well. So it looks like, you know, and then we'll probably hear more about this again on the earnings calls about where the flow is going for deal making, for M&A activity.
Yes, absolutely. But, you know, as you say, trading desks are doing well. Volatility can be your friend. And then obviously we've seen this over at Morgan Stanley this morning as well. Strength in equities trading there too. The wealth management segment was also fairly robust, so that's worth pointing out too. But we saw a beat across the board there from Morgan Stanley to 16.79 billion on estimates of 1604. As I mentioned, the wealth management 7.76 billion versus the estimates of 7.35. As I said, equities holding up. So, you know, another sort of, I suppose, consistent picture as far as what we're hearing from the others when you look at that side of the equation.
Yeah, indeed. I mean, in terms of the market reaction seems to be muted to Morgan Stanley. Not seeing a surprise to see the strength in wealth management. That's been a big part of what differentiates Morgan Stanley from the other banks. Of course, obviously they have the trading business, the IB business, but a big part of it has been wealth management, asset management there. All right, Sam, thank you so much for the deep dive across the banks. That's a look across Bank of America, Goldman Sachs, and Morgan Stanley. But that's not the only earnings in focus today. Our thanks to Sam Vadas.